Sorry, I was reading some news. Can everybody hear me okay? All right. Well, here we are. It's time for money management. We're a significant way through the course. Covered back testing, yes, we've done that already. That's going to play a role here, and you're going to start to see how the money management piece of what we do works in conjunction with the back testing that you're doing and all of the data that you're going to be accumulating on your spreadsheets. Now, Darren, do we have that? Do they have the spreadsheet, or is that something that we're sending out? If not, we can get it. We can get it uploaded to the Documents tab now. Okay. So what we're going to do is basically I'm breaking this up into a couple of different parts. The first part is going to be kind of a little education on money management and the type of money management that we use and why we do that. And then the second half is going to be running through the spreadsheet with you. This will be a little bit longer training than you're normally used to, just simply because of the length of the content that's involved and the ability to go through and navigate the spreadsheet. Now, we considered how to do this a bunch of different ways, and one of the things, like I said, is my goal here is really to empower you guys to be self-sufficient in all of your endeavors, all your trading and investing endeavors. And we took a long time to create a spreadsheet that really does a lot of the work for you that I'm going to be talking about here today and mentioning to you. One of the reasons that we're taking time to run through this first half is because I feel like it does you an injustice to just simply show you the spreadsheet, show you how it works, and then have you put in your data. I want you to really understand why we chose a smooth ratio money management strategy. What are some of the other options that you have? What's the difference between risk management and money management? And also dispel some of the myths that are involved with trading and managing money, because there are a whole lot of misconceptions about the best way to do it. And I'm going to give you my suggestion. Okay, this is what we have come up with at Trade Empowered as the best alternative, or the best way to manage your risk and to manage your money. Now, naturally, you can use it or not use it like anything else here. You can choose to employ it, and to what extent you choose to employ it is up to you, or you can not at all. You can just go out there and wing it. And really, if you use a Keel strategy of, too many lots, trading that $5,000 account, over time, you can generate, like I said, a really nice return based on that. What I want to show you how to do is take the risk management that Keel uses at 2 units and then apply some money management to it and allow you to increase and decrease position sizing as your account changes. And when you do that, now all of a sudden you start to really see that account grow. You start to see some astronomical growth, and I'll show you how that works here in the presentation. Does that sound good? Any questions so far? Any questions about anything in the program so far that I can answer for you? You guys naturally have me this week in the live trading room, so I'm also going to be in Tuesday and Thursday in the live trading room. Mark, I see you're typing. I can only assume that's for me. If not, then we'll go ahead and kick this thing off. Now, all right. I'll start by just covering a couple of myths, or covering at least the first myth here. And the myth being that a great trading system should be your main focus. And I write this down because this is the vast majority. How many people, just by kind of saying yes, would say that at least for some portion of your trading career, that was your main focus. It may have even been your main focus when you came in here to look at and say, wow, man, this pattern stuff's pretty cool. That's new. I've never heard of that before. I'll go ahead and take a course, spend a bunch of money on a course. Try and learn that system. Because if I learn that system, if I learn that strategy, that's where I'm going to make my money. And now, if you didn't say yes, because Neil said yes and everybody else just kept quiet. If you didn't say yes, I know you're lying to me, because I've been in your shoes. I still look for that type of that type of system. I'm still constantly looking for a trading strategy that gives me a better percentage point return. The problem is that that is really not a main focus that we look at. It's one of the things we look at when putting together our business, but it is not the main focus. And this is where you want to know why 98% of traders fail, or 95 or 90, or whatever you want the number to be, whatever you say the number is, okay? If you want to know what to do, look at what 80 to 90% of the market is doing, and then do the opposite of that. How many people have been sucked in by the new Bitcoin craze or the new binary options craze? Anybody been researching that, been looking at that and saying, oh yeah, maybe I'll sit in on a little sales pitch on that so I can hear a little bit about it, right? It's the constant search for the new, for the interesting. Oh, I want to learn about this. Let me go check that out. Oh, there's a new way to trade. Maybe that's the way that's going to fix my problems. This is the same basic concept, is that we have a natural inclination to move away from what we're currently doing into something else, and to constantly be on the lookout for the next shiny object. But here's the deal. Your trading system should have a positive expectancy, and that is the only critical piece of the puzzle. So it doesn't matter whether your trading system is a little bit profitable or super profitable. For our purposes, the only thing we're looking at for is a positive expectancy. Now, I'm going to admit to you guys, there's no sense in trying to say that if you have a system that does basically a little bit better than break even, that is not going to perform as well as one that produces a 300% yearly return. No matter what money management we apply to that, it's going to be tough to make those two systems equal out. But most traders spend far too much time jumping ship from a system that makes or promises to make a few extra percentage points. So what we're really looking for is we see, oh, that system's 80% accurate, or that one's 70% accurate, and we're jumping system from one to another, or this one creates, this one has less losing trades, or this one lets me trade in 3 or 4 different markets. All of these different things, we end up jumping around from system to system. And I see this from guys even who have been through our programs, who, when we put out new trading systems or we do new products here, is they end up calling us up on the phone and saying, hey, I'm thinking about buying this, what do you think I should do? And the conversation we always have is okay, how is your current trading going? Whatever you came in doing, how is that going? If you're going to change strategies, why? Is there a specific reason for that, or is it just the fact that, hey, I haven't followed the rules on the strategy I'm using now, so now I'm going to transfer over and I'm going to buy something else? And we tend to dissuade people from doing that. I don't want you. I'm not going to tell you how to spend your money, but if you ask me, I'm going to tell you, hey, if you're not focusing on what you're doing now correctly, there's no reason to change strategies into something else. Trust me, I don't need your money that bad. I don't want to put you into a position where you're just going to make the same mistakes again. Let's focus on what you're not doing right. Maybe what you should be doing is going to BJ Nash and having a course on trading psychology. Maybe you should be running through one of those programs that he puts together, so that you can focus on that aspect of your trading rather than just buying another system. Okay, but your goal should be to find a system with a positive expectancy and then add money management to the strategy. So the question may be, what is positive expectancy? Well, I wrote, refill your coffee cups, people, because we got to do some math. And as much as I would like to avoid doing math, because I don't particularly like doing math, it's when we talk about money management, there's no way around it. But what I am going to do is try and make this simple enough that even a knucklehead like me can figure it out, because I did the PowerPoint presentation, so it's got to be easy. So positive expectancy is defined as a mathematically proven probability that a trader will end up with profits, not loss. Now, how much profit? I have no idea. Depends on what the expectancy of the model is. But when you have positive expectancy, you have a mathematically proven probability that if you do the same thing over and over again, you will have a profit rather than a loss at a given period of time. Everybody got it? Now that equation is expressed like this. 1 plus WL times P minus 1. And while that might seem a little crazy, we're going to go ahead and break down the numbers, and I'm going to simplify it for you by adding in some actual digits. So let's take a look. Let's throw some numbers at it and make it make a little more sense. So the first thing we're going to look at is this WL, and the WL stands for win-loss. So what is your average win and your average loss? So let's throw a couple of numbers in there. Let's say that our average win is about $535, right? Maybe, let's say we either got a big account or we're swing trading or we're position trading, and yeah, we got a pretty good system here. When we win about 535 bucks. Pretty good. Nice little profit there. And then our average loss is going to be somewhere around $310. So right off the bat, we got a pretty good system, right? We got the start. Hey, we're making good profit when we win. Our profits significantly outpace our losers. And we've got the start of a really nice system. We're winning more than we're losing. Okay, that's a good sign. We're on the right track. Now, we take that $535 and we're going to divide it by $310. Okay, what we get is 1.72. 535 divided by 310 is 1.72. Then we're going to take that 1.72 and we're going to add 1 to it, giving us 2.72. Now, the P in the equation stands for probability. What percentage of the time are we correct? So we're winning $535 and losing $310 every time we right, every time we're wrong. Now here's a question: how often are we right? So what are the two things I always tell you need to know? What are the two questions you ask yourself when looking at a trading system? How much do I make when I win? How much do I make when I'm right? How much do I lose when I'm wrong? How often am I right? Correct? This is something that I've talked about for years. If you've been following me for any length of time, this is what we discuss. How much money do I make when I'm right? How much do I lose when I'm wrong? And how many times, or how often am I right? Now, why do I tell you to do that? Because that's how we determine expectancy. So for P here, we're going to have to make a determination. So let's say that we're about 58% profitable. Okay, that's pretty good, right? We're winning $535 every time we're right. We're losing $310 every time we're wrong, and we're right about 60% of the time. This is an example of the type of trading system that we want to look for. This type of system will crush the market, especially after you put money management on top of it. But in this particular case, 58% profitable. This is a great system. This is exactly what we want to see. So we take 2.72 and we multiply it times 0.58. That's going to give us 1.577, and then we're going to subtract 1. That gives us 0.58. A positive 0.58. Now, does everyone understand what I just did? Are there any questions on that? This is going to be important. You guys are sharp cookies, but I know we have some people who some ESL students. English is not their first language, and I want to make sure that the math challenged in the room understand what we're talking about here. If you don't, then when your recording comes out, rewind it, watch it again, watch it 15 times until you figure out what it is that we're doing here. The math is very, very simple. If you've been to high school, you should be able to do this. So now we have a system that is 0.58% profitable. The outcome of this equation must be greater than 0. The greater the number, the better the system. If the number is less than 0, then you have a losing system. Before you can apply any money management strategy, your system must first produce a positive expectancy above 0. Now, the question becomes, How far above zero is a good strategy? Yes, that's a fair question. I don't know the answer to that question. It's going to depend entirely upon your risk management or your what you're willing to risk, your risk tolerance. Okay, so some of you may be willing to trade a specific strategy if it has a very narrow expectancy, and you're saying, look, I don't have a 0.58 probability. I've only got a 0.35. But I've got a positive expectancy. I'm extremely disciplined. I know my numbers. I know this thing is solid, and I'm going to go ahead and trade it. Some of you may say, hey, 0.58, that's not good enough for me. I want a 0.7. Good luck with that. If you find one, let me know. Why aren't you using pips? As everybody deals with a different account. Well, we're talking specifically about win to loss ratio in a dollar figure. So it doesn't it doesn't matter if it's 1,000. Your position sizing doesn't make any. If you have a different account, if you've got let's say you've got more money, so you're using so it's $1,500 for every winner and $1,100 for every loser. It doesn't make any difference. Your average win versus your average loss. This is how you figure out the expectancy. We wouldn't do it in points if we were in the futures market. We're going to use the actual dollar figures. I just didn't unprivatize the room. We can unprivatize the room. I don't care. Hang on. So we don't use pips. We use the actual dollar amount. And it's not going to make any difference because your profit and loss is going to be different based on what you're doing here. So anyway, I lost my train of thought. Good grief. The reason that we apply money management, that it must be greater than zero, is because we really, although there is technically a way, no, there's not. There's not a way. I thought that I was thinking over this last night as I was reviewing the training material for today, and I thought, well, is there a way if we had something that over time lost money, but we were able to increase position size during the winning periods and decrease position size during the losing periods, that we could end up reversing that and creating a profitable trading strategy out of one that produced a negative PE. And if it is possible to do it, I don't know how it would be done. Okay? So we want to have a positive expectancy that is greater than zero. Once that's done, now we can apply money management to it, and we can try and get the absolute most out of that particular trading strategy as possible. Okay? Now this is an important consideration. There are many things that can affect your results. A PE above zero can quickly go negative in the hands of a trader who does not utilize good discipline and manage their trade state. So what are we saying there? Okay? One of the best things that I ever heard Todd Brown say is that the greatest trading system in the world is worthless in the hands of a trader who will not follow it. Right? Guys, it doesn't matter. I get traders who come through the program, they do all of the work, they put in the effort, they do the back testing, they spend time in the live room, they do all of their money management spreadsheets, they do it all, and they have this solid plan together, and they're like, look, I've written out the trading plan, I've done the testing, I know it works, I've got my money management strategy set up, and then they go out into the market, and guess what they do? The exact opposite of what they should be doing. Instead of following the plan, they end up going back to all of their old bad habits. They end up running into the drawdown. They know the drawdown's coming. They anticipated the drawdown, but for some reason, instead of trading through the drawdown, instead of continuing to follow the plan, they start to modify the plan. And guys, when you do that, you erase all of the work that you've done. All of that testing, all of that preparation means nothing. You understand? An expectancy above zero can quickly turn negative in the hands of a trader who does not utilize good discipline and manage their trade state. Everything that we're doing here is going to be worthless if you get out into the market and don't follow the plan that you've laid out. Myth 2, money management and risk management are the same thing. How many people thought that? That they were interchangeable? That I can just flip-flop money management and risk management, it's kind of the same thing. To be honest, a lot of people bundle these together, but they are very different strategies, okay? They deal with two separate issues, and one of the reasons we break this up is because I want to clearly define what we're talking about, okay? Risk management is a process of ensuring that you are never in a position of exceeding your maximum allowable drawdown limits. Now, who sets your maximum allowable drawdown limits? You do. You set those. If your broker's setting your maximum allowable drawdown limits, then you're in trouble, Mark. But you set your drawdown. What are you willing to lose on this system? Okay? Too many people look for the system that has a specific, it says, okay, this system takes a maximum drawdown of 30%. No. The system will take whatever drawdown you assign it based on your position sizing. Now, you may not be able to reduce your position sizing low enough to get the type of risk that you want, and in that case, you would have to switch systems. But in most cases, you can assign a specific drawdown limit and say, hey, I don't want to lose more than 20% of my account. I don't want to lose more than 30% of my account. Right? Could you lose 50? Could you lose 60? Sure, it's up to you. I'm not going to tell you how to spend your money. I'm not going to tell you what kind of risk you should be using. I can tell you if you absorb more than a 50% drawdown, you're in pretty significant trouble, because now you've got to double your account to get back to zero. The more you lose, the harder it is to regain that that new structure high, that new equity high. But risk management, the only thing that we're dealing with is protecting capital, right? We're not interested in growing capital when we talk about risk management. I want to make this very clear. Risk management has to do with protecting capital. It is the most important thing, in my opinion, for new traders, is risk management. How am I defining my risk? Now, we do this on a portfolio basis, not on an individual trade basis. So we're gonna talk more about that in a minute. But when we talk about risk management, what we want to do is make sure that we do not exceed our maximum allowable drawdown limits. Now, money management is the act of increasing or decreasing position size to create maximum return with the lowest possible drawdown. So money management deals with, okay, when things are going well, at what point do I increase my position size? At what point do I start risking more money on the trade? When it goes the other direction, when do I start pulling back? When do I begin decreasing my position size? Which one of these does Akil do in his live room? Which one of these two? Risk management, yes. Why does he not do money management? Anybody have an idea? Because we always use the same lot size. Basically, the reason that we do that is because you've got too many different people with too many different account sizes. Okay. So what if I came in there and I had a $250,000 account? Okay, and I was trading 20 lots. And I started increasing and decreasing my position size based on the profit or loss that I was making. Do you think that your increase and decrease might change if you had a little different risk tolerance than I did and you were trading a $5,000 account? Absolutely it would. Do you think it would be confusing to people in the room to try and take that very personal aspect of money management and try and blanketly apply it to, you know, people from half a dozen different countries and varying position and varying account sizes? It absolutely would. So what do we focus on? We focus on risk management, making sure that you don't lose all your money. So we say, hey, if you got a $5,000 account, we're going to trade 2 mini lots, and we're going to produce a 40% return over the year. And hey, guess what? If you've got money management, you turn that 40% into 140% potentially. Does everybody make sense? Is there any question about the difference between the two of these? Yes, he does. He trades the same position size every day in that room. I see you typing, Monty. I'll wait for you. Okay. So risk management, how do most people do it? Ever heard this one? I'll never risk more than 2% on any trade. Okay? That's my risk management. Okay? Now this really, it's not really a risk management strategy, and I'll explain why. It's really more of a form of fixed fractional money management. So this does not fall into the risk management category. It really falls into more of a money management strategy, but it doesn't protect you from, and it doesn't do that for several reasons. Okay? Number one is that it doesn't take into account how many positions you have open at any given time. So if I say, oh, I only risk 2% on any given trade. Well, what happens if you have 8 trades open at once? Now you don't have 2% risk on your trade. Now you've got 16% risk. You think that makes a difference? Well, it should, because it also doesn't factor in the maximum number of losing trades in a row. So I've got 16% exposure, and I've at one point taken 16 losing trades in a row. Guess what that could mean? It could mean all 8 positions that I have open at any given time take the maximum loss of 2%. I lose 16% on my account, and then I take another 8 losing trades for a total of 16 losing trades at 2% per trade loss. What is that, 32%? You just lost 32% in your account. Does that meet or exceed your maximum allowable drawdown limits? Is that within them or outside of them? It doesn't factor in maximum drawdown in pips. How many total pips am I going to have? Because you got maximum number of losing trades, right? Let's say, hey, the most number of trades I had in a row that were losers was 16. Shoot, let's say it was 6. All right? And inside of those 6 losing trades, I lost about 150 pips. But my maximum drawdown in pips is 500. Because just because I have 6 losing trades in a row, then I might have 2 winners, then another 6 losers. Then 1 winner, then another 6 losers. Right? So we need to not only be keeping track of how many losing trades do we have in a row, but what's the maximum drawdown in pips that we're going to receive? Does that type of money management strategy address any of those issues? Absolutely not. Therefore, we haven't really created any sort of risk management in our trading system, have we? We've given the illusion of that, but that's really all it is it's illusion. All right? Now, this is how risk management should be done. You need to ask yourself some questions. Number one, what is my starting account balance? These are writer-downers, guys. If you don't have your pen and paper out, writing this stuff down, you need to be doing that. What is my starting account balance? Okay. What is the maximum drawdown for the testing period? So for my testing period, my back testing, what was the maximum drawdown? This would be in pips for the testing period. How many pairs or markets do I trade inside of my portfolio? Like I said, we're not going to do this on a trade-by-trade basis. We know that you're going to trade more than one currency pair. All we say to do is define which ones. Are you going to trade one pair or are you going to trade 20 pairs? Define them. Which ones are they? And make sure you've tested every one of them to make sure whatever you're doing produces a profit on those currency pairs. And then 4, what is the maximum drawdown I am willing to accept? Everybody got it? Okay. The math looks like this. Let's say I have a starting account balance of $10,000. I'm using $10,000 because I want to keep the numbers easy. The math will be easier this way. So I got $10,000 account balance. I have a maximum drawdown. My back testing, for my back testing period, the maximum drawdown in pips, not in dollars, the maximum drawdown in pips was 300 pips. Okay. The number of pairs that I trade is 4, so I'm trading 4 currency pairs. And my maximum allowable drawdown is 30%. So I say I don't want to take more than a 30% drawdown. What's reasonable? I mean, if you're going to be aggressive as a trader, 30% drawdown, I mean, it's more than I would probably want. I mean, I really don't want to see. I mean, I think about it in terms of, if I have a $100,000 account, would I be comfortable losing $30,000 of it? Just watching that vaporize. Regardless of how much money I could potentially make on the back end, let's say, oh yeah, you got to take a 30% drawdown, but you'll be able to create a 100% return a year. Are you willing to do that? I don't know. For me, it's a little too much because, you know, I've been around the block once or twice. I don't need to create massive returns a year in order to be very comfortable. So what I tend to look for is, how do I create, 3 to 5% a month in return? 2% would make me just chipper. But on net, how do I create a 25 to 30% return a year? And what do I have to have in terms of a drawdown in order to achieve those results? That's for me personally. It has nothing to do with you. But for the purposes of our argument, we're going to look at this and say, okay, $10,000 account, 300 pip drawdown, trading 4 pairs, maximum allowable drawdown of 30%. This is a definition that I make. Okay. Now, in order to figure out what the maximum drawdown is, because I'm saying, hey, I've got a maximum drawdown of 30%, take 10,000, divide it by 30, you get $3,000. So the maximum drawdown in dollars that I can take is $3,000. Does everybody get that? Like I said, I don't want to make anybody feel stupid, but I mean, I just want to make sure that we understand the process that we're going through, the math that's being done here. So I'm going to figure out what a 30% drawdown is of $10,000, and that's $3,000. Like I said, it makes the math easy to do it this way. If I have $3,000 and I'm taking and I've got a 300 pip drawdown, that means I can risk no more than $10 per pip, right? Because if I risk more than $10 per pip, then I am going to exceed at some point my $3,000 drawdown. Everybody understand? Say yes. Let me know you're with me. Thanks. Thank you. Okay. Now, but remember, I have 4 pairs that I trade. So that means that $10 has to be spread loaded across 4 pairs. Because can you foresee a time in the future when I may have all 4 of my pairs open at the same time? Therefore, we have to spread load those 4 pairs, that $10 across 4 pairs. That gives us about $2.50 per pair. Now again, guys, one of the things that I'm doing is I'm being ultra conservative here. Ultra conservative. Because what percentage of the time do you have all 4 pairs out? Technically, you've got 300 pips of total exposure, of total risk. So could you potentially trade $10 for every single pair, so trade 1 standard lot for every single pair and not exceed your maximum drawdown? It's possible. I'm being ultra conservative here to ensure that there is almost no chance of you ever exceeding your maximum allowable drawdown. So if I spread load across 4 pairs, that's $250 or $2.50 per pair. That means that for each pair, you can risk no more than $2.50. If you trade 2 targets, you will need to risk no more than 1 mini lot per target. By doing this, you will give yourself the highest probability of staying within your predetermined allowable drawdown. Okay? But this is the process of looking at risk management and saying, okay, how do I ensure that this 30% is never exceeded? Any questions on that? How much would be a reasonable drawdown? Yeah, I can't tell you that, Raphael. I don't know what, I can't tell you what your reasonable drawdown would be. Some of you guys will be very aggressive. You will say, I am absolutely willing to take a 30% drawdown if I can create an 80% return a year. Other guys will look at that and say, there's no way I could stomach that. And I would caution you guys, when you say that you would be willing to do that, oh, Jason, if I knew that I could create a 100% return a year, I'd accept a 30% drawdown. Oh, yeah, absolutely. Until they watch their $10,000 account go to $7,000, or until they watch their $100,000 account go to $70,000, and they realize they just lost $30,000. Normally, it doesn't take that long. Normally, they hit $10,000, $15,000, $20,000, and they start sweating bullets. Because now all the questions start to crumble. Oh, maybe my system's not working anymore. Oh, maybe this isn't, even though it's completely within their allowable drawdown limits, even though it's something that they talked about before they started trading, when they actually get out into the market and they start putting their money at risk, now everything changes. Now the money's real. It's not just numbers on a paper anymore. It's my real money that I put into that account. And all of a sudden, what they thought that they were willing to accept as a drawdown is nowhere close to the amount that they're really willing to accept. How many of you guys have put a position on and you put your stop out there and you knew what your stop was when you put it out there? You knew how much you were risking, but you thought the market was going to go in your favor. And then when the market started to go against you, now all of a sudden the idea of losing all of that money became almost unbearable, to the point that you had to move your stops. Does that sound familiar? Anybody ever moved a stop because they got freaked out about the risk? Okay. That if you, and we've all done it. So I mean, yeah, absolutely, I've done it a million times, a dozen times. I've done it many, many times. Okay. A person who does that is someone who did not accept the risk at the beginning of the trade. They might have said, oh yeah, I'm willing to risk $200 on this trade until I come to the realization that I might actually lose that $200. Now all of a sudden, maybe I'll just make it $100. Don't really want to lose $200. So you got to be careful. You got to make sure that what you're saying you're willing to accept as a drawdown is what you're really willing to accept, because the way you're going to set up your risk management is to ensure that you don't exceed that. Not that you don't hit it, not that you don't come close, but that you don't exceed it. All right. Although this process provides you a reasonable assurance that you will not exceed your drawdown limits, it does not guarantee it. There are important factors that can affect your actual numbers, and they are the amount of data used in your testing, the length of time covered, the risk that performance will degrade over time, reducing return and increasing losses. And this is something that I want to discuss this just briefly, because you get a lot of traders who are very worried, and not so much guys who do structure trading, but guys who do system trading. So, for example, a Liberator or something like that. Guys who trade systems, they're constantly, one of the major concerns they have is, hey, how do I know when the system is not performing right? And they have this I call it an irrational fear that one day they're going to wake up and the system is just going to explode. Just not going to. It was working fine. It was making me 20% a month, and then I wake up on a Tuesday and it wipes me out. Right? System totally blows up on me. Number one, a well-designed system with solid back testing, that doesn't happen. Well, I'm not going to say it doesn't ever happen, but it's very rare. We've never had that happen here. What we do see happen here is a degrading of the system over time. One of the things that people don't realize is that for whatever reason, and I've asked Todd about this because he develops all the systems for our company, I asked him, why is it that day trading systems tend to need more tweaking than higher time frame systems? Because it's all charts. I mean, shouldn't a 5-minute chart perform the same as a daily chart or a weekly chart? And he said, yes, it should. It just doesn't. And he said, I don't know why. But if you're going to have a day trading system, you have to monitor it and you have to make sure that you don't need to make any adjustments. One of the big things about day trading systems is that you see wide variations in average range. Okay, so for example, the first time I taught this course, we were talking about oil, the oil market, and I said 6-8 months ago, oil was trading. The daily range of oil was about $4, and I said now that daily range has shrunk to about $1.25. Now, do you think if you go from a $4 range to a $1.25 range in a given day that you're going to affect the trading, the performance of a trend trading system? And the answer is absolutely you are. So you've got to be constantly on top of that and be diligent about making sure that you're not seeing it. But what you don't see is you don't see a thing go from making money hand over fist to just exploding and blowing up your account in an afternoon. Excuse me. What you typically see is, hey, market goes from trading at $4 down to $3, down up to $3.50, down to $2. So you see this kind of over several months, a degrading of a strategy where, hey, it's just not producing the same results that it was producing 6 months, 8 months, 10 months ago. And now you've got to look at it and say, what's changed? Now, the better you are at it, you'll start to recognize these things early on. You'll start saying, well, man, this was a terrible week. Look at the ATR. We're just not seeing a lot of, range-bound movement. We're seeing a lot of range-bound movement here. There's not a lot of directional movement, and it's showing up in my account balance. But that's something that can affect the performance of a trading strategy over time. Also, if you didn't select enough data, you're doing a day trading system and you only did 2 weeks worth of back testing, that is not enough back testing to have a reasonable assurance of how your trading strategy is going to perform in all markets. So you have to do that as well. And we have really a deeper process. We do some manual testing first, and then we go into some longer-term back testing, typically 6 or 8 months. Then once the numbers look good there, we do our tweaking. We make sure that we are kind of in the pocket for that 6-month period of time. And then we go out and we've got some software that we use that tests back about 5 years. And for everything that we do here, we do a 5-year back test. And we say, okay, it performed well over the last 8 months. We think we've got it kind of dialed in here. Now let's look at 5 years and find out what the performance was. Because we do find at a given time, at certain times, that a trading strategy has performed well over the last year, but lost money the 3 years prior. And that's not a system that we want to use. Now, it doesn't mean that we can't, tweak that system to get a smoother equity curve, but in many cases, we just have to drop it because it's not profitable. How would this calculation be modified if you consider different leverages? Well, it doesn't change. Okay. Your leverage is only determines how many positions you could have, what your total risk allocation could be, how quickly you could go broke. But, because you got to put up margin. The only difference between when you're with your leverage is how much margin you have to put up for the trade. So for me, I mean, the only thing about that 50 to 1 does is it means I can't have as many trades open. Because what do we know about, did any of you go to the Trader Summit that we held in January of this year? Did anybody go to that? Okay. One of the things that we talked about, and I tried to pound into guys' heads when we were there, is that if I have a machine and I put a quarter in that machine and I turn the little crank and 50 cents falls out, that's kind of what I want to see, right? If I have a machine that does that, how many times do I want to put a quarter in the machine? How many times? As many times as humanly possible, right? How fast do I want to do it? As fast as I can. Because the faster I can put quarters in that machine, the faster it'll kick money out. So if I have a trading strategy that produces me a 20, 30, 40, 50% return a year, if I just follow that strategy, take for example cipher patterns, okay? If I know that the cipher pattern produces a profit about 80% of the time, and I'm right somewhere around 70% of the time, how many times do I want to trade a cipher pattern? Every freaking time I find one. What are my only limitations there? The amount of capital I have to use. Now, every time I place a trade, my broker says, all right, I will give you that money and I will give you some margin to trade it on, but I'm going to give you money to trade that position on, but you're going to have to put up some margin. Every time I pull margin out, that reduces my ability to trade something else. So one of the things that high leverage will do for you is that if your numbers are tight, if you know what you're doing is working, then you can take out 6, 8, 10, 12, 14 positions at a time. And you will have the margin to cover that in your account. If you get down to 1 in 100, 1 to 50 margin, well, now all of a sudden you can't take out as many positions. Does that make sense? But in terms of your risk management, in terms of your drawdown, your actual margin has absolutely nothing to do with that. The only consideration is, hey, do I have enough margin to take out all the positions that I want to take out? I know a lot of guys say, well, I follow 20 currency pairs. Really? How big is your account? How big is your account to handle 20 currency pairs? It's going to have to be big. Otherwise, you're going to be in situations where you can't take out trades because you're tapped out your margin. Does that make sense? Okay. Now, let's talk a little bit about money management. And I just want to share with you some of the different kinds of money management so that you'll have an idea about some of the other stuff that's out there. This isn't anything that we use, but it gives you a brief overview of some of the different strategies that you can use. The first one is called the martingale strategy. Is anybody familiar with this? This is really a gambling strategy. And what it says is that every time I lose, I'm going to double my position. You see this strategy used a lot at roulette. So I put $100 on black and I lose. So then I put $200 on black. If I lose again, I'm going to put $400 on black. If I lose again, I'll put $800 on black, right? It's a martingale strategy that says, I'm going to double down every time I lose, because then when I win, I'm going to win back my money much, much faster. Okay? This has been proven time and time again to be a losing strategy. It may work well for you for a very long time, but when it goes bad, you will erase your account. And the reason being is because you will run out of money before you run out of drawdown. Okay? Every time that roulette wheel spins, what are your odds of it coming up on black? 50-50. Once you've taken 50 losing trades in a row, it's come up red 50 times in a row, what are the odds that the next time it's going to come up red? 50-50. Exactly. The fact that you've had 80 losing trades in a row, the next trade, the probability is still 50-50. One of the things that people don't get about trading is, let's say you've got a trading system that over an extended period of time, several years, that you have an average, you're right about 80% of the time. Okay, so about 8. People look at that and they say, wait, 8 out of every 10 trades will be a winner. Okay, the problem is how those trades get dispersed. Could you realistically have 2 losers, 1 winner, 2 losers, 1 winner, 2 losers, 1 winner, 2 loser, 1 winner, 2 loser, 2 winner, 2 losers, 1 winner, 2 losers, 1 winner, 2 losers, 18 winners? You could potentially have a disparity that works like that, right? There's nothing saying that is after you get 2 losers that, hey, I could potentially have, now the run should come. I've had my 2 losers, now the run should come. What's going to tell you, what is going to be the important piece of information that you're going to need to know in addition to what % profitable you are? What's going to be critical in you knowing how that disparity may work out? Yes, what is the maximum drawdown in pips? Good job, Neil. What's the maximum drawdown in pips? Because what does that tell you? That tells you what to expect. It gives you an idea of how those percentages may be dispersed out. But even that is not 100%. We're dealing with some broad ideas here and some stuff that we can do to kind of limit our drawdown. But if we know what our drawdown is, now we can prepare in terms of our risk. So martingale, not a very good strategy. The other one's called the anti-martingale, and what it basically says is as you are winning, every time you have a winning trade, you will reduce your position size. Because the idea being that every winner takes you 1 step closer to a loser. Again, what we know about the dispersion of wins to losses, this just doesn't play out. There's a 50-50 chance on any trade that you're going to have profit or not. Over time, those the averages play themselves out. Fixed fractional. This is a money management strategy that we will talk about. It's actually one that a lot of large funds use. That basically says, I'm only going to risk a certain percentage, or I will only risk 1 contract for a given account balance. So say 1 contract for every $10,000. I'm going to trade 1 lot for every $10,000 I have in my account. That's fixed fractional. Cost averaging. And cost averaging is basically a process. Some of you who are investors may be familiar with dollar cost averaging, and it basically says as the market decreases, I'm going to continue to buy. So it's one of those things. Have you ever heard a lot of investors say, well, I love it at 10, I liked it at 10, I love it at 8. At $10, it was a good buy. At $8, it's a steal. So I'm going to continue to buy. I'm going to average my cost down. Now, if you are an investor, I can see times when dollar cost averaging makes sense. If you are looking at the numbers and you believe that a company is extremely undervalued and that you're buying value, this is a strategy that can be utilized. I still don't think it's the best strategy, but it's one that you can use effectively. Because although companies do go to zero, it's not it's not that big a deal. You want to make sure you're being very careful with your leverage if you're using dollar cost averaging, because it can wipe you out if you're using leverage. And then the other one is pyramiding. And pyramiding is basically the process of as the market moves in your direction, you continue to add to the position. So you're averaging the other direction. I don't like pyramiding, although a lot of traders have used pyramiding to create astronomical returns. I've never liked it because I'm averaging my position the wrong direction. I'm averaging I got in it. What I try and do is pick the best entry price with the least amount of risk and the highest reward. Okay. It may have been a strategy that the Turtles used. I don't remember. Okay. But when I pick entry points, I try and pick the place that will give me the least amount of risk and the highest potential reward. Every time I pyramid, I move that line. And I don't like doing that. So I don't use pyramiding. Now, what we do, the foundation of what we do, I told you smooth ratio money management is what we teach, but fixed ratio money management is actually the strategy that smooth ratio is based on. And the easiest way to explain this concept is to use a variable known as a delta to determine when to increase or decrease position size. And let me show you what this means. Okay, this is the formula for fixed ratio money management. Now, for those of you who are getting freaked out at all the math here, the spreadsheet does all this for you. I am simply showing it to you and giving you the recording so that you can go back and review it if you guys decide that this is something that you really want to understand. Okay. But if we're looking at this, basically what we're looking at is required equity plus the number of units times the delta equals when to increase position size. And if we throw some numbers in here, let's say we have a $10,000 account balance. Okay, we're trading 2 units. Now a unit can be whatever we decide it to be. It can be 2 standard lots, it can be 2 mini lots, it can be anything. It's a unit size. Okay, it can be two S&P contracts, it doesn't matter. $10,000, 2 units times the delta. Now here we've chosen a 2,000 delta, essentially a $2,000 delta. And we're saying, okay, this delta is, I think delta, I'm not a math wizard or anything, but I think delta actually means variable in math. This delta can be anything you want, and we can adjust how aggressive or conservative the money management strategy is based on what that delta number is. So we've got a $2,000 delta multiplied times 2 gives us $4,000. If we take 10,000 plus 4,000, that means we're not going to increase our position size until we hit $14,000. Once we hit $14,000, we're going to go to the next position size. We're going to add a contract. We're going to add a unit. Okay? Now what happens if we take this 2,000 and we make it 1,000? Well, now instead of increasing at $14,000, we're going to increase at $12,000. So we're going to by reducing the delta, we increase the rate at which we increase or decrease our position size. Does that make sense to everybody? Is there any questions about that? It's okay if there are. I went through it really fast. Like I said, the software does, the spreadsheet we have does this for you. All you have to do is put in what you want the delta to be. No. It doesn't mean 2 trades at a time, Ronald. It means I trade 2. So let's say on a Gartley pattern, we trade 2 mini lots, right? Target 1 and target 2. That's 2 units. So every time we put a trade on, we're going to trade 2 units. If you trade some of our other trend following systems, you might trade 3 units. Make sense? Okay. Is there a way to know what delta should be used? Yes. Once you have your backtesting data, I'll show you in a minute. Once you have your backtesting data, now you can play with the delta to see how that affects your equity curve. Okay? I'm going to show you in a minute, guys. We didn't give you the spreadsheet ahead of time because I don't want you guys playing around with it. I just want you listening. Okay, so here are some I told you fixed fractional money management versus fixed ratio money management. Now, this is basically how we increase position size. Now, fixed fractional, what I told you is that's where we say, okay, I'm going to trade 1 contract for every $10,000 I have in my account, or 1 lot for every $10,000 I have in my account. So in this particular, with fixed fractional money management, what happens is you trade $10,000 until it hits $20,000. At $20,000, you increase your position size. At 30,000, you increase your position size again. At 40, you increase your position again. Now, the problem with this is if you are a new trader, you're a trader with a small account, like a $10,000 account, you have to double your account before you use any money management at all. Before you get to apply any money management, you have to double your account. Now, I said a lot of large funds and institutional traders will use this type of money management, but they're starting out with, say, a $100 million account. So they're going to start out trading 300 contracts, and literally every day they're going to have the ability to adjust position size based off the profit and loss that they're seeing in their portfolio. A trader with a small trading account, this makes it very, very difficult to apply any money management as you're getting out of the gate. So what we do is we move over to a fixed fractional money management strategy that allows you to increase your position size at relatively consistent intervals. One of the other things that you'll notice about fixed fractional money management is that the more money I make, the quicker I increase my position size. So it requires less and less capital to increase my position sizing the more money I make in fixed fractional. Okay? This also exists some in fixed ratio, but what it allows us to do is get out of the gate a lot quicker. So for those of you who have smaller accounts, which is pretty much everybody in here, this is going to help you be able to employ some money management without having to wait to double an account. Okay? Fixed ratio allows for accelerated growth in your account, allowing you to ramp up your position size much quicker as your system produces positive trades. It also allows you to decrease position size more rapidly as your system moves into drawdown, allowing you to increase the rate of equity growth while not conversely increasing the drawdown at the same time. Now, one of the cool things about this is it's tough for you guys to see the equity curve growth here. But on the top, I have a fixed fractional money management strategy, and below here, I have, on the lower chart, I have a fixed ratio money management strategy. And all we've done is we've grabbed some sample data here. Over the course of the sample period, the fixed fractional money management strategy yielded about a $12,000 profit. So it went from $0 to about $12,000 in profit. A nice, really nice profit out of that particular trading system. The fixed ratio money management strategy generated a 15%, or I'm sorry, a $15,000 return. So that is a 30% increase in equity with virtually no increase in drawdown. Okay? What we can do with fixed ratio money management is we can increase our drawdown, or we can increase our return without increasing our drawdown relatively. So normally you would think that, hey, if I'm taking a 10% drawdown and I'm getting a 20% return, then if I want to create a 40% return, I got to take a 20% drawdown. It doesn't necessarily have to work that way. Depending on how you increase and decrease the position size, you can increase your overall return without adversely increasing your drawdown. Does that make sense? Because look at these two equity curves. They're almost identical, right? You don't see any wild pullbacks here because we're increasing and decreasing position size quickly as our account moves into new equity highs or drawdowns. And we're able to create a 30% additional profit out of the same trading system without really increasing our drawdown at all. Now, what are the major drawbacks? I'm trying to get through this, guys, because we've been here an hour so far. The major drawbacks of fixed ratio money management, because of the way fixed ratio calculates the delta, as you continue to trade, it will require smaller and smaller increases in equity to add position size. This causes parabolic moves in equity if traders consistently, if traded consistently, and creates the potential for violent equity swings. And that's evidenced right here, where you see this market shoot all the way up, and then we have this very violent action here at the end because you're trading so many contracts that is bouncing around. Now, this happens late in the day, and it's not terribly important. Because in reality, have you guys ever seen those equity curves where guys are like, oh yeah, all I needed. It's like I generated a 300. I generate a 300% return a year, or I generate 100% return a month. That's what I do. And here's the evidence to prove that I generate 100% return a month. And you're thinking to yourself, well, hang on, 100% return a month. If I put $10,000 in there, that means month 1 I'm at 20,000, month 2 I'm at 40,000, month 3 I'm at 80,000, month 4 I'm at 160,000. It's like at the end of 2 or 3 years, I'm going to be a trizillionaire, right? You're like, that doesn't make any sense. It's because what's happened is the guy has taken a very simple trading strategy. Maybe it's profitable. Maybe it's just nothing but fake numbers. But then they've applied a money management strategy to it that generates them the return that they want. Is that return reasonable? Probably not. But this is the type of stuff that they will do to show you the massive returns that you can get by trading a specific system. Our answer to this, to the problem of having violent equity swings at the top of the equity curve, is to use what's called smooth ratio money management. And all smooth ratio is, I'm not even going to explain it to you. There's a document that talks about it that it should be in your training material. It's basically a calculation that says, I won't allow you to increase position size more than X amount per interval. And you do not need to understand this to use it. All smooth ratio is it just they add a slowdown multiple that says, okay, even though technically your next level should be 10 units, I'm only going to let you increase by 3. And what it does is it smooths out the equity curve and it creates something else. This is the same set of data, okay? The same data. The difference is that this one went from about $0 to about $200 million, and this one went from $0 or $10,000 to about $400,000 over the same period of time. The difference is, when did we increase position size? And how much position size did we increase? With the smooth ratio, what we do is we limit the number of contracts or the number of units that you can increase at any given time. Again, I know it's complicated stuff. You don't really have to know this stuff if you don't want to, but I feel the need to explain it to you so that you understand at least foundationally what we're doing here from a money management perspective. Are there any questions with this? The next thing I'm going to do is walk you through the platform, the spreadsheet, and show you how you can use it. Any questions at all? Nothing. Not a single one? Okay. Now what I want to do is I'll let you guys mull that over for a little bit. I want to take a 10-minute break because I need to get some water. And then we're going to come back and I'm going to show you guys the spreadsheet. We're going to walk through the spreadsheet, and then we're going to go from there. Sound good? Big discussion in the office. Darren came out and was questioning my 50-50 flip scenario. And I don't know that I've convinced him that I'm correct, but he said he's gonna go dig up some more research and come back and confront me later. But now we're going to take a look at, did anybody come up with any new questions? Let me shut my door. Okay, well, it's all right if you don't have questions now. You can always have questions later. That's why we're here. We'll answer them. I guarantee you, as you start to move into the spreadsheet and you start playing with some of the numbers, that some questions will probably come up. So what we're going to do now is look at the actual spreadsheet. Now, on the first page here, Darren, if you have this spreadsheet, actually, I'm going to send you in HIP chat. I'm going to send you a document over, Darren. This is the new spreadsheet that we used at the technical trader workshop. I'm sorry, the summit. Let me find it here. Documents. And I'll show you the guys the spreadsheet in a minute, but I have this spreadsheet has sample data in it. Let me see here. Hang on, I'm trying to find this here. There it is. All right. Coming to you, Darren. Okay. So this has sample data in it that I can use, you know, for testing purposes. So on the first page here, what you've got is your pip values, and these guys, you can plug these in if you want to give you a more accurate reading on what your actual unit size will be. So if I know that the euro is the dollar yen's trading at $12, the euro USD is at, you know, $10, you can adjust these position size, and you've even got a little link in here that takes you to the pip calculator, so that you can use that as well. So we got a little pip calculator, so you can tell what the current pip values are for each one of the pairs that you might trade. So on the next sheet is the backtesting sheet, and the cool thing about this is, I'm just going to run through this kind of at the top. You've got your, this is going to give you a readout of some information that's going to be ready access. So your gross pips on a per unit basis, your average losing streak, your maximum losing streak in pips, total units traded, your account equity, and then over here you've got winners versus losers versus scratch trades. So how many did I win, how many did I lose, how many broke even? And then over here, of course, we've got errors made. So I've got a place in the spreadsheet that actually lets you discuss or lets you write in what your problem was. Okay, so if you had any issues on the trade, let's say that you took the trade and you ended up moving your stop. You know you shouldn't have done it. It was against your rules. You made a mistake. You can put that in there. You can say, hey, I moved my stops. I got stopped out here, and I made a, you know, it was an emotional mistake or whatever. Now, inside of this trading spreadsheet, we've got several different things in here. Now, some of them you will use, some of them you won't use. We basically put this spreadsheet together to encompass a lot of different trading strategies so that you could use it for whether you're using a liberator system or whether you're using pattern trading. We've got entry date, entry time, the currency pair that you're using, the chart interval, you know, was on an hourly chart, a 15-minute chart. What is the trading system that you used? Okay, because what if you're using Gartley patterns and butterfly patterns and all of those different types of things? You've got a type of entry. Now, type of entry is typically restricted to some of our mechanical trading strategies where you've got first strikes and second strikes and those types of things. So it's not really pertinent for your use as a structure trader. But you may want to identify, hey, that this was a DSR double top or something like that. ATR, average true range, you don't need. CTS, if you're a CTS trader, one of the things you can do is you can write in what was the CTS score so that you have that in your backtesting. And again, one of the things that when we talk about backtesting is, what do you want to make sure you do when you backtest? You want to make sure you collect as much information as possible. Everything that you think you're going to need, you want to have, because you don't want to have to go back through. There's nothing worse than doing 20 hours of backtesting and realizing that you forgot to record the date. The dates of the trade happened. Now, I know this happened to me. No one bothered to explain this crap to me when I was learning how to backtest. And I did 20 hours of backtesting and realized that I didn't write down any of the dates. I wrote down the days. I was smart enough to write down the day of the week, but I didn't write down any of the dates. So guess what I had to do? I had to go all the way back through my backtesting again and write down all of the dates. It was a huge pain. I hated every minute of it, but learned my lesson. Now, Also have your entry price, your initial stop loss, your target 1, target 2. If you have a target 3, that would be in there. If you want to put in the day it was closed and the time it was closed, what are the benefits of having that? If you know when you opened the trade, and you know when you closed the trade, you also know how long you were in that trade for, right? How long was that capital at risk? And also, if you're doing day trading, you can put in the closed time so that you know how many hours your money was at risk. Then you have your exits, position 1. Where did you exit the market? Exit price 2 and exit price 3. Okay. Then maximum favorable excursion. MFE and MAE are not things that you will use here. Chart notes. Any chart notes you want to put in here. Anything you want to add about this particular trade, like big news event or something like that. Anything in here that you want to have, that'll go in your chart notes. Rules followed 100% of the time, yes or no? Did you follow the rules? Errors made. Okay? We've got a few of them in here. We've got emotional, trade management. You can also add others if you want to add more so that you can add in additional issues that you might have. Order entry, trade management, fear and greed, emotion. So all of those are in there, and all you got to do is you just highlight there and you click on the little tab to the right, and that gives you the issue. And then it updates, of course, here in your spreadsheet. Okay? Then all of this stuff, closed pips, all that stuff is already pre-calculated. It's done for you, so you don't have to worry about it. So you don't have to add in any of this stuff. It actually does the calculations. And you can see up in the top here in this scroll bar, I don't know if you guys can see that. Can you guys see this at the top? Yeah, you can. You can see where there's actual code. So if there's code in there, don't touch it. If you touch the code in there, you're going to screw everything up. So that's my disclaimer. Don't touch where there's code. Anywhere where there's not code, you can put in whatever you want. But if there's code there, leave it. So what we can do is we come down here and we just start adding in all of our data. Every single trade. Yes, it is a very, very comprehensive spreadsheet. We wanted something that would really work for you guys, okay? So you have all of your data here from every single trade that you took in your back testing. You can also, for your back testing, okay? That's what this is. It's for your back testing. Then we move on to the money management section. This is the part that everybody wants to see, okay? So now we have fixed size. So if we use no money management, and then we have our trade empowered money management or our smooth ratio money management. So you can see right here starting account balance. What do we have? Well, let's say we've got a starting account balance of $10,000. What's our maximum acceptable drawdown? What are we going to allow our drawdown to be? I don't want more than 20% in my drawdown. Lot size. What am I trading? Am I trading micros? Am I trading minis? Or am I trading standard lots? Okay, I'm going to trade mini lots out of my $10,000 account, and I don't want to accept any more than a 20% drawdown. Okay, so these are my points in here. This is going to give me some of my position sizing. My starting units, I'm trading 2 units, so I'm trading two targets here. Okay, can you make mistakes emotionally on back testing? If you're making emotional mistakes in your back testing, Peter, I'm going to tell you to hang it up. You will feel some of the emotion behind it, which can be helpful to you because when you're taking those losses. But if you're not taking a trade in back testing because you don't want to feel the pain of losing back testing money, then you need to not be trading. That's going to be my advice to you, because you are so emotionally on tilt that this is not the industry for you. And I'm not saying that's you, Peter. I'm just saying that if you're running through backtesting and you're literally like fudging your backtesting numbers and you're not taking trades in backtesting because you don't want to feel the pain of that being a loser, then you are definitely in the wrong business. Now, here's our delta. Our delta tells us when we're going to increase or decrease our position sizing, right? So how aggressive do we want to be? So let's take a look at this. Now, right now, we've got it super aggressive. We're at 200. That means every time we get a $200 increase, we're going to increase our delta. And that creates, as you can see here, if you look at the left here, all of these are the same unit size, right? This is just like a Keel would do it in the live room. It's 2 standard contracts every single time, all the way down the line. Then look at what happens here. 2, 285, 752, 790, all the way up, right? So now we get into our money management strategy here. Now, our slowdown multiple is at 16, which means it's basically not doing a lot for us in terms of slowing down this rate, but I'm going to change some of these numbers up and I'm going to show you what a difference it can make, okay? So take a look at this here. We got 2 units, 85 units, 75 units, but we're increasing every time we get a $200 winning trade, or we increase our equity by $200. So what if we made this $2,000? What do you think it's going to do to our overall return? Okay, let me go back to 200. At 200, we basically made, what is that, $350 million. Again, this is simulated data. It's not important. This is something that we threw in here. We had some more realistic data. I don't know, Darren, where that spreadsheet went, but this is, this looks like something that we would fake, you know, for training purposes. But this is not real data. So we got $350 million in profit. Now, if I change this to a $2,000 delta, it drops to 35. Oh, it actually drops to, what is that? 3.5. So a significant decrease there, and look at what happens from the way we increase our position size. It increases much slower because it's taking us a lot more time to increase our position sizes. Everybody get that? So we're trading, instead of every $200, we're increasing every $2,000. Now what happens if I make this $5,000? If I make it $5,000, well, now I'm increasing position size even slower, and now I only made about 1.4 million instead of 3.5. So I'm limiting my overall return, but what do I also limit when increasing, when decreasing my position size, or when decreasing my, or increasing my delta? I also decrease my risk, right? So now, let's play with the slowdown multiple. Let's say, okay, you know what? I get this, but the rate that I'm increasing position size, look at this. I go from 5 contracts or 5 units to 17 to 24 to 25, then to 33. It increases so fast. I'm really nervous about, you know, one day I come in and I'm trading 2 units, and then 2 days later I'm trading 17 units. That's just too much for me. I really am not comfortable with that amount of risk out there. So I'm going to take my slowdown multiple from 16, and I'm going to take it to 5. Okay? So now I've got my $5,000 delta, and I've got my slowdown multiple at 5. Now look at what it does. Now see how we've got a nice, even, steady climb as we increase our equity? And we don't have these wild jumps from 5 to 17 to 33. And we get a much smoother equity curve as the market runs up because we're increasing our risk. We're increasing our position size at a steady predefined rate. I can reduce this down to 3 if I want to. Okay? And again, it's just going to slow down the rate at which I increase my position size. It's going to give me a much smoother equity curve, not this, you know, not a lot of jumping around. Now, one of the ways that this will help you, that you'll notice when you put in your live data, and Darren, we just make a note, I want to get some data in here that actually shows some drawdown, because this is not very valuable in terms of the drawdown. I want to be able to see that. One of the benefits of this particular, of having a slowdown multiple, is when you have something that that is not as streamlined from bottom left to top right, when you have some significant, say you have a 10 or an 18% drawdown. One of the things that can happen is that if you are increasing your position size really rapidly, you can get violent corrections in price. Because let's say that you just increased your position size from 17 units to 25 units, and then you immediately run into a drawdown, and you have a couple of losing trades, and now all of a sudden you were up 30%, and now you're dropped and you've lost half of your profit. You go from being up 30% up 15% in a couple of trades because you're increasing your position size so rapidly. So one of the ways that we avoid that is by adding in the smoothing factor, the slowdown multiple, and that slows down the rate at which we increase our position size. Make sense? Any questions on that? So what you have to do is you have to come in here based on your back testing data, and you have to say, okay, I've got a $10,000 account. I'm willing to accept a 20% drawdown. I'm trading mini lots. I'm trading 2 minis. My starting unit size is 2 minis. Okay? And now you can, once you've got that information in place, now you can play around with your delta and your slowdown multiple and the number of pairs traded in order to find the equity curve that you're comfortable with, the amount of return, the amount of drawdown that you're comfortable with. And you're going to be able to see, okay, what does it do to my account if I get a little bit more aggressive on my money management? Am I willing to accept that? Did you say that this could be adjusted to reflect futures? Yeah, it's very. This is set up for. This is set up right now for Forex. I think we have one for the futures as well, because you'll need a little bit different. You'll need it'll be a little bit different. Any questions on this part of it? Now, one of the things that we can do when we get this dialed in and we say, okay, that's about the best that I can do for this particular strategy. That's based on all of this back testing data that I've done, looking at my money management sheet, this is about the best equity curve that I could come up with. Now we're going to roll over to the back testing tune-up sheet. This is where this really gets cool. Okay? So I have here, I should probably have, these are the different types of trades, okay? So if I go back here to my backtesting sheet, I'm going to zoom in here. Here are the different trading systems, okay? We got the HARM trading system, we got the GXC trading system, we got the GXBC trading system, and if I go to my tune-up sheet, you're going to see all of those different trading strategies, okay? So if you were a pattern trader, you might have Gartley, butterfly, bat pattern, crab pattern, that type of stuff, right? That might all be in here as a different strategy that you're trading. Now, also in addition to that, you have your type of entry. So for us, that really doesn't matter. We can just take a look at the trading system. But if you have a type of entry in your backtesting tune-up, I can drop down and I can look at, these are all the different entry types that I have. Now let's break this down a little bit further and let's take a look at the days of the week. Now, were there any days of the week that my trading system didn't perform very well? Look at that. Oops. Well, for the RC entry, Sundays was a terribly losing day. That didn't perform very well. Let's look here. Well, again, Monday for the GXC didn't perform well at all. That was a net loser. The BAT lost 13. That was a net loser. Again, the RC lost Monday, Tuesday, and Wednesday. The only day it made money was Thursday. So over net, The GBC trading strategy or entry trading system did not perform well, or entry did not perform well. Okay? Now, why is this valuable? What can I do with this? Well, let's break it down. Let's open up Sunday. Let's look at times a day. What time of day didn't perform very well? Or what times of day performed really well? Well, the only time that really performed well was about 9:15. It was the only time we actually made any money. So really, maybe I shouldn't trade this particular strategy on Sunday. I could potentially erase that from my trading strategy. I could remove that as one of my trades. Down here, I can look at this particular trading strategy, and I can say, look, this thing lost money Monday, Tuesday, Wednesday, Thursday. Maybe I just don't want to trade this one. Or maybe I don't want to trade it Monday, Tuesday, or Wednesday. I only want to bring that in and trade it on Thursdays. What you're going to find here is all kinds of hidden information. You may find out that, hey, your trading system, while it performed really, really well, lost money every Monday morning. Monday afternoons was great, but Monday mornings was terrible. Lost money every Monday. You may find that a specific currency pair, you might have looked at, say, Aussie dollar, and you might have traded cipher pattern on Aussie dollar. And what looked like, when you looked at your initial back testing, like, hey, Aussie dollar just doesn't produce a profit with a cipher pattern. Okay, I'm just pulling a number out here. Say, well, Aussie dollar didn't produce a net profit in my back testing, so I don't want to trade that. But when you have this sheet, you can actually break it down and you can take a look and say, well, maybe Aussie dollar lost money on Mondays and Fridays, but Tuesday, Wednesday, Thursday, it made money. And if you got rid of Mondays and Fridays, you would take a losing system and you turn it into a winning system. Do you see how being able to drill down all of this backtesting data that you've collected, being able to come back into your backtesting tune-up sheet and actually look at that data, look at all of the different things, every single variable that you plugged in over here on your backtesting sheet is available in your backtesting tune-up. You can literally go through and look at anything. Winners, losers, where did you make the most money? The options here are really limitless as to what you want to look at. And you can break down your trading system. You can break it down on on a system basis. You can break it down on a time basis, on a day of the week basis, on a monthly basis. Anything you want to do to look at the data, you can break it out however you want to. Can you see the benefit of having that? Of being able to break your numbers out that way? It's incredible. I'm very excited about this. This really is huge. And nobody else, to my knowledge, does this or teaches this. Nobody else gives you guys this level of, a product that allows you to go out and reach out and look at your trading strategy and to make adjustments, right? And see where the money's really coming in. Then we move on over. Now we have our live trading log. Because the real question is okay, got my money management, I know what I want my setup to be, how do I trade it? When do I know I need to increase or decrease my position size? Well, that's in your live trade log. You're going to it looks exactly the same as your back testing log, it's just in real time. So you're going to enter every single one of your trades into your spreadsheet, and then you've got your live equity. And your live equity is based off of the tune-up, the backtesting money management that you've lined out here. And it will tell you, you just need to go in here and take a look at it and say, okay, yep. Time to increase position size. What's it say I need to be trading right now? 2 units, 3 units, 6 units? What do I need to be trading? And then, of course, you also have a live tune-up sheet as well, so that in real time you can be running through and checking your numbers and making sure, okay, how are things panning out? How are my numbers looking? See how this is getting more and more like a business every day you guys are here? Hey, we're keeping good records. We're making sure we know what our strategy produces. We're looking at the books every night to make sure that our profit and loss is good, to make sure we don't have money leaking out here or there. We've got the tools at our disposal that we need to really understand what it is that we're doing. And now all we have to do is get out there every single day and trade the plan. And my goal has always been to provide you as many of the tools as possible for you guys to be independently profitable traders. And this piece, I think, is critical for you guys to have and for you guys to understand. Now, we do have a new spreadsheet. I'm going to show you that because I added a couple of things to the new spreadsheet. New spreadsheet looks just like the old one. You've got your tick values, you got your back testing, your money management. You've got, but you also have this back testing review. Okay. And what this does is it gives you some representations on a chart of what your average win, average loss is. There's a bunch of stuff in here that that's going to give you some nice graphs that are really easy for you to look at. And then you've got, of course, the same thing in your live trading. So I'm going to give you both of these spreadsheets for you guys to use. Any questions about anything we've talked about today? You guys are kind of quiet. All right. How do you know how fast you should increase your trading lots as you put in the initial number? Well, that, guys, you don't know. That's why you play around with these numbers. You have all your back testing data, right, that you enter into the spreadsheet. Then you come into your back testing money management tester, and you start looking at what's my starting account balance. What am I willing to accept as a drawdown? Am I trading mini lots? Am I trading 2 pairs or am I trading 4? Okay, if I trade 4, it's going to change some things up. And all the math here is done for you. So all you have to do is take a look at your equity curve, take a look at your drawdown, take a look at your increase and decrease of position sizing, and then play around with your delta and your slowdown multiple to make a determination. I would use, yeah, John, he showed you how to use, how to create a backtesting spreadsheet because we wanted you guys to know how to do that, because down the road, you know, you may want to have that skill, and it's important that we walk through the logic of it. But take your information that you've got in that spreadsheet that you've been doing your backtesting on and transfer it into here, because this is where you're going to get all your money management information. Yes, this is an Excel spreadsheet, yeah. Yeah, this is typically, you know, people are just like, man, I'm a little lost when they get done with this lesson. When you get into this and you start looking and you watch the video again, you start playing around with the spreadsheet, it's going to make sense, okay? You're really only looking at 2 things. You're taking all of your back-tested information, and in your money management sheet, it's programming this stuff in here, and then all you're doing is really adjusting your delta and your slowdown multiple to determine when to increase and decrease position size. Darren's going to be emailing this to you. Is it email, Darren? Is that what we're doing? Or is he, or are you going to put it underneath this video in the recordings on the site? Uploaded. Yeah, that's probably best. Okay, so Darren will have it uploaded to the site today as soon as the video is posted, so you guys can download all of it and play with it. Okay? Any other questions? Like I said, I'm going to be in the live room this week, so we can talk about this more if you guys want to talk about it more. You guys better be more entertaining if we're in a live room this week, because I got to tell you what, I like feedback. Yeah, John, if you're going to be transferring the information, you're going to need the same. Again, look, You've got entry date, entry time, currency pair. If you don't have the chart interval as one of the things that you recorded, you can just leave that blank. That'll be just one thing that you cannot access when you come to your backtesting tune-up sheet. One of the things that won't be in here on the sidebar is that function, is that field. Okay, so if you didn't record all of this information when you were doing your backtesting, then you won't have that field to access, but you can just come and plug in the information in the appropriate field. But there's no need now that you have this sheet to do your own backtesting sheet. Good question though, John. Anybody else? Catherine, I see you typing. And again, it's a long lesson. When we increase our position size, do we increase the number of contracts on a trade or increase the lot value on the trade? Catherine, I think those are the same thing, unless I'm misunderstanding. So if I trade, let's go to the money management sheet. So starting units is 1. So let's make our starting units 2 units because we're trading 2 mini lots. Okay. So here we go. 2 mini lots, 2 mini lots, 2 mini lots. Now we're trading 3 mini lots. Now we're trading 4, 4, 4, 5, 6, 7, 6, 7, 7, 7, 7. So you're trading mini, 3 minis, 4 minis, 5 minis, 6 minis, 7 minis. All you're doing is increasing those. Can you lock cells for us that have your formula so we don't mess it up? I don't think those cells, some of the cells you can't access, maybe all of them are unlocked. Look, be careful. You can always download. I would save when you save this, John, to your hard drive. Save one copy and then open up a new copy and then save it as your backtesting sheet. So that way you've always got a master copy. That way if you happen to screw it up. But if something happens and you're like, I guarantee you there's going to be more than one person who's going to call us up and say that our spreadsheet is broken, that it's not working right. And what we're going to find is that somebody has cleared out one of the cells that has important information in it. Okay? It happens. Just recognize you'll be wrong when you send us an email to tell us that our stuff's messed up. And it will end up that you are messed up. But that's okay, because we'll fix it. Okay? We've been using this spreadsheet for quite a while, and it works great. You can skip the odd lots. Mark's saying, well, what about 3? Because I've got 2 targets, then how do I trade 3 minis? Well, you tend to trade 3 minis. You can take off, you can take off 2 and 1. You can take off 1 and then 2 on the secondary targets. You can do that however you want to, or you can just go straight to 4 if you want to, and then increase in intervals of 2. I would not recommend that. I would just follow the strategy and say, okay, well, I'm trading 2 targets. I got 3 mini lots on, so I'm going to trade, 2 and 1. I'm going to take, half, 2/3 of my position off at the first target, and then I'm going to have a runner. Otherwise, you're increasing your position size quite a bit more. You're doubling it. But it's up to you. Yeah, absolutely. I've traded patterns that way. Yeah. Look, your percentage accuracy comes from your initial target. Your follow-on target is nice because you pick up some runners up to those 618s in the secondary targets. But if you're right 70-80% of the time and you're taking off 2/3 of your profit on the initial target, there's nothing wrong with that. And if things are profitable and you're doing what you're supposed to be doing, it's not going to be very long before you're going to be trading 4 units anyway. Sorry for asking again. No, it's all right. We just vary the delta and the slowdown multiple until we see an increased level of contract over time, which seems like, yeah, what you're basically doing is I've given you the ability to play with the numbers and find something that you are comfortable with, okay? This can be very dangerous ground for me as an educator because I cannot give you personal advice. I cannot give you a spreadsheet that just blatantly tells you when to increase and decrease position size. Number one, that would be wrong of me because it doesn't take into account your own individual financial situation, and it doesn't take into account your risk tolerance. Okay, those are things that I don't know, so I can't make a blanket spreadsheet that says, okay, this is when you increase and decrease. What I can do is I can teach you how to do that for yourself, and I can give you the tools to determine what's comfortable for you. So I teach you about how a delta works, how a slowdown multiple works, how you do back testing, and how you get the information into the spreadsheet. And then I teach you how you can modify delta and slowdown multiple and maximum acceptable drawdown to potentially modify equity curve. And then it's your responsibility to go do that testing, to put it into the spreadsheet, and then to find something that you're comfortable with, that meets your standard or your criteria. That's my obligation. That allows me to deliver the information to you while at the same time not crossing any legal boundaries that would get me into trouble. Cool? Yeah. There's a reason I teach this, and I don't allow anybody else in our organization to teach this. Okay? Anytime we start talking about dealing with money, people's money, I want to make sure that we're very, very clear. So that is it's not that Akil could not teach this program or could not teach you money management. It's that I want to make sure that what's put out here in this class is correct. It's very, very important to me. Any other questions? Those are all good questions. If there's nothing else, then we have been running 2 hours, and I'm just going to let you guys go. Sound good? All right, guys. Well, thank you so much for your time. I will talk to you all tomorrow in the live trading room. So bring your A game, be ready to discuss, be ready to trade, and I'll see you guys then.